Okay, so the last time we were talking about the financial statements. So today we're going to continue talking about the financial statements. So we talked about the balance sheet and the income statement. And we were talking about some accounting view the last time. So we said that accounting view, we prefer book value rather than market value. So we prefer the historical value rather than the current value. Depreciation. Do you know what depreciation means? We studied the vocabulary. So accountants can measure depreciation in two ways. The first one is a straight line. So the second one is accelerated. So straight line depreciation looks like this. Accelerated depreciation looks like this. So accelerated depreciation is more realistic. So this is the accelerated one. And this is straight line. So if you have a car, okay, your car starts off, it's $20,000. Do you think the car depreciates the same amount every year?
No.
Or more in the first year and more in the less in the fifth year? How much will your car depreciate the first year? Half? Okay, so you think half, so 10,000. Okay, then the second year, how much will it depreciate?
5%.
Not much, down to 9,000. Okay, next year,
5%.
again 8,000. So you think it's like this way, accelerated. The first year the depreciation is very fast, right? Then the next year is not so quick. Okay, that's more normal depreciation. Straight line says it's going to get to 8,000, so the first year it's going to depreciate to 16,000. The next year it's going to be 12,000. And the next year it's going to be 8,000. So according to this depreciation, it depreciates 4,000 every year until it gets to zero, right? This will get to zero eventually, and this will get to zero. So when we get to zero, it doesn't have any value. So accountants can use whatever they decide. They can decide to use accelerated depreciation, or they can decide to use straight line depreciation. So we'll talk about that later. It's also related to tax. Because depreciation is included in expenses, it depends on our profit for each year. Okay? So if we're a young company, maybe we want to use accelerated depreciation because the first year we get some advantage, right? Because we have a big expense, so we can say that we made less profit and pay less tax. So we can talk about that more later. So we can choose these two types of depreciation. You understand accelerate in English, right? Inventory. So how does the accountant value inventory? Another word for inventory is stock. The stock of goods in the shop. So what is the inventory for the shop down on the first floor here? What kind of inventory do they have? Snacks, coffee, right? All of the things they have in the shop. That it's not cash and we didn't sell it yet, okay? But it's still something we have. So we need to give it a value. So the question is, how do we value inventory? So one way is first in, first out. So the inventory is valued based on the cost of the material bought latest in the year. And then last in, first out, where the inventory is based upon the cost of the material bought earliest in the year. So the snack price could go up during the year, right? The snack price could change by beg one or e-beg one. So we're deciding which price should we use to value, the early price or the late price. Okay? So accountants can decide. They can use the latest price or the earliest price, or they can use the average cost between the two. So next is liabilities. So it's a definition of liability. This is, it must be expected to lead to a future cash flow or the loss of a future cash inflow at some specific date. The firm cannot avoid the obligation, and the transaction giving rise to the obligation has happened already. So this is just the definition of a liability for accountants. So if we have this situation, then it means that we are going to put it in the liability section. So again, for liabilities and equity, the accountant wants to use historical costs rather than the market cost. So this is important for equity. The value of equity is always changing every day. Okay, but the accountant looks at what was the historical price of the equity for the book value. So accrual accounting, this is recognizing the value of the good in the period in which the good is sold. So this is for accounts receivable and accounts payable. So we talked about that in the last time. We have accounts receivable and accounts payable. So in accounts receivable, did I sell something or did I buy something? In accounts receivable, am I selling something or buying something? Selling, right? Did I get the money yet?
No.
No. Did I sell the product?
Yes.
Yes. So the accountant has to decide, are we going to record this now or not? I didn't get the money yet. Am I always going to get all the money from my customers? There might be some case where I don't get paid or I don't get all the money, right? But the accountant is going to record like I already got the money. That's what this is, accrual accounting. It's the same for accounts payable. Accounts payable means that I bought something and I have to pay later. But it's still included in the accounts. Under accrual accounting, it's recorded today as income or outcome, even though the cash has not been received, but anyway we using the accounting. So for example, it's December, okay? We do our accounts in the US every quarter, so we need to finish our accounts in December. But we sold some goods that we're not getting the money until January or February. So we include this in the accounts for December. So our stockholders can see the accounts, including this sales. So expenses. When accountants do expenses, they split it up into operating, financing, and capital expenses. So operating expenses, in theory, the operation is like day-to-day operation is often used together. So this is benefits in the current period. For example, the cost of labor, salaries, materials. For example, if I'm making coffee, what materials do I need to make coffee? Coffee beans, right? So if I'm a coffee shop, coffee bean is going to be an operating expense, okay? Materials I use to make the product, okay? It changes, usually it changes. The cost of labor changes, I have to hire more people or less people. And coffee beans changes, I need more coffee beans or less coffee beans, okay? So, the next one is financing expenses. So financing expenses, we already gave the example of the restaurant. If you start a restaurant, then how do you fund the restaurant? 100% your own money? Do you have any financing expenses? If you use all of your own money? No, right? You use all your own money, you don't have any financing expenses. What about if you get a loan of 90% from the bank? Do you have financing expenses? Yes, what financing expenses do you have?
Interest.
The interest, right? If you use all your own savings, you don't have to pay interest, okay? If you use the money from the bank, you have the financing expenses that we put into the expenses, okay? And capital expenses, capital, we already saw that capital means money, okay? But we can also use capital meaning kind of long-term things for the company. So this is like buying land and buildings is a capital expense. Now there are some unusual things that accountants do here. Operating expenses, we said it should be things which we use on the day-to-day basis, like salaries or electricity or materials for our product. But in practice, accountants put depreciation. We just talked about depreciation. They put depreciation in operating expenses. Research and development, they also put in operating expenses. And lease. Do you understand lease?
Yes.
Lease is like a long-term rental. Long-term rental. They can also put those expenses here in operating expenses, even though they're not normally operating expenses. So instead of accounting that the first year we lost $20,000 because we paid for a car, they're going to say that because we use this car for the company, for the coffee shop over 5 years, each year we're going to say we lost $4,000 for 5 years. Okay? So they will put depreciation minus $4,000 in the operating expenses in the income statement for 4 years. So year 1 you lost $4,000, year 2, right? So it looks like at the start your loss is not that big. If you lost $20,000 in the first year, it would look like a big loss. Okay? Anyway, sometimes businesses don't have to pay tax in the first year. And anyway, I lost money in the first year. So it doesn't make much sense for me to have another $20,000 in the first year. Isn't it better to have $4,000 every year? Then I don't have to pay tax on this $4,000 every year. Okay? So it's a way of using accounting so the companies can balance their taxes better. Okay? So just to explain that again, if I lose 20, anyway in the first year I'm not going to make a profit, with or without the car. So if I make no profit, do I pay any tax?
No.
No, you don't, right? So anyway I'm not going to pay tax. So do I need to write down minus $20,000 for the car in year 0 or year 1? It's not going to help me with taxes, right? But if I write down the depreciation year 1, year 2, year 3, year 4, maybe I start to make a profit in year 3 or year 4, then it's going to help me with the tax, because I'm making a profit, so now I can have minus 4,000, right? And then I can pay my tax later, so I pay less tax. So companies are allowed to do that, to put also research and development. They do the research and development cost at the start, right? But if I'm starting a new pharmacy company, and I do research and development for 5 years and spend a lot of money, then I made a loss in all of those 5 years. And then I start to sell my product, right? Then I start making a profit. But wouldn't it be better for me if I could balance my research and development cost in the time that I'm making a profit? Then I can pay less tax. Okay? So this is used in accountancy. So then let's talk about some calculations. The first calculation, this is to show a little bit about the performance of the company. The first one is called return on assets, ROA. So return, we're talking about the profit. On assets means compared to our assets. How much is our profit compared to our assets? So if I told you that you have assets, cash and buildings and so on, worth $1 million, and your company made a profit of $100 last year, do you think you did a good job? No, right? What's 100 over 1 million? It's very low, 0.01% probably. That would be your return on asset, 0.01%. Okay? So return on asset is giving an indication of performance. Also for the financial manager, is the financial manager doing a good job? I gave you $1 million. How much profit did you make with the $1 million, right? I didn't give you $1 million, I gave you $10 million. So how much profit did you make? So you made a profit of $100,000, right? And you made a profit of $200,000. So it sounds like you did a better job. You made a profit of $200,000. But actually, your return on asset is 10%, right? And your return on asset is just 2.5%. So in the end, he did a better job. With less money, he made more percentage. So this is what return on assets is measuring. So we have, on the top line, we have EBIT 1 minus the tax rate, and then on the bottom line, I don't know why it's missing here, it should be assets. Assets is written here on the bottom line. So it measures the operating efficiency on the operating profits from its assets. So if we just explain this EBIT, what is EBIT? EBIT means earnings before interest and taxes. So if we look at the income statement, we're going to have something like this, right? We have revenue at the top, where we get our money from. So this is an income statement or profit and loss account, right? So we have revenue, then we have costs. Okay, then here we're going to have EBIT. This is earnings before interest and taxes. Okay, then we're going to have here minus taxes. Okay, then here we have net income. Net is after taxes. It's the same for your salary. Okay, if you get a salary, you have gross income before taxes, net income after taxes and pension and so on. Okay, so EBIT is this line here. We're talking about revenue minus costs. Okay, so here we have interest payments and taxes. Okay, so when we're doing this calculation, what we do is we cut out the interest payment, the financing cost. So we use EBIT here, and we multiply that by 1 minus the tax rate. It's really just minus the tax. So if my EBIT is 100, right, and my taxes is 30, okay, then it's the same as saying 100 times 1 minus the tax rate is 1 minus 0.3, so 100 times 0.7 equals 70, okay? So it's really just EBIT minus taxes. So we're just excluding the interest payment in this over assets.
Chris,
Yes?
is EBIT like gross income?
Yes, you could say it's like gross income.
But why didn't write gross income instead of EBIT?
Well, maybe this one could be gross income revenue. Then we take away the cost, and then in the end we have net income. Why don't we write it like that? Maybe it would be simpler, but people use different terms. This is called EBIT, okay? Earnings before interest and tax.
So revenue is more like gross income.
Yes, revenue is just the money you get before you deduct anything. So gross really means before any deductions. Yeah. Then later you're going to have to pay your costs. Okay, then you'll have EBIT. Then you'll have the bottom taxes and then net income for your company. So return on capital is, we have on the balance sheet, on one side we have assets, on the other side we have debt and equity. Okay, so instead of putting assets on the bottom line, we put debt plus equity minus cash. Okay, debt plus equity minus cash is return on capital instead of assets. So more commonly used is return on assets. We'll look later. Then on top of this we have return on equity. So return on equity is similar to return on assets, but in this case we're just using equity instead of assets. So in this case we're just looking at from the point of view of the shareholder. Return on assets, we could be looking from the point of view of the bondholder, the shareholder, the employee, anybody in the company. But return on equity is a figure which is specifically for the shareholders. The shareholders own the equity in the company. So if I invest in the company, I want to know on the money that I invested in the company, what is the return? Okay, I'm not worried about assets or debt. All I'm thinking about is the equity that I put into the company. So to give you an example, I'm your father. Not really, it's just an example. Yes, don't look so surprised. So I give you 10% of your company, 10% of the money, okay, and you use 90% loan. So at the end of the year, you make a profit of $100,000, okay? So I want to know, then you pay the interest payment, say $50,000. At the end you have $50,000 left, right? And I gave you $10,000. So what was the return on equity for me? About 500%, a very good return, right? I gave you just $10,000, right? You got a loan of $90,000, your interest was $50,000, then you still have made a profit of $50,000, and I made my return on equity. So return on equity, should that be a higher or lower number than return on assets, usually? What do you think? Say return on assets is 10%. Will return on equity usually be higher or lower than that?
No.
So it should be higher. Okay? With assets is more or less equals to debt plus equity. So on the balance sheet we have assets is equals to debt plus equity. Okay, so if I have return on equity, right, then it's going to be a higher number than return on assets. So say my assets is 100, okay, my debt is 50, my equity is 50. So my father's money 50, my money 50, okay, I buy a restaurant worth 100. The restaurant is my asset. This is where I got my money from a loan and from my father. My father wants to know, first of all, we could get return on assets. Let's say we made a profit. EBIT times 1 minus the tax rate, right, was, let's say, 20 last year. Okay? What's my return on assets? What is the return on assets in this case? What percent is my return on assets? EBIT over my assets. EBIT times 1 minus T over A. What's this number? 20. So this is 20. EBIT times 1 minus T, which is just my revenue minus my costs minus the tax, right? And my assets is 100. So what is 20 over 100? 0.2. What's 0.2? It's 20%, okay? That's my return on assets. How about my return on equity? In my return on equity, we have to add in something else. We can see on the top line, it's net income. So in the return on equity, we have to take out the interest expenses, right? That's only fair, because we had some debt here, so let's say our interest rate was 10%, just to make it easy. So our interest expense was 5. Okay, so we have 20 minus the interest, minus 5 is 15. Okay, so this is my net income. So my EBIT is 20. Okay, but now we add in the interest to get my net income. So interest expense was 5. 20 minus 5 is 15. So what is my return on equity? What percent is my return on equity? 30%, right? So net income, ROE equals net income. So my net income is 15, right? Over equity value, 50. 15 over 50 equals 30%. So can you see why return on equity is going to be higher than return on assets? We're not including the debt on the bottom line, right? Here we're including the debt with assets, okay? Assets is equals to debt plus equity. So this is 100. Big number on the bottom line. But return on equity is just 50, okay? This number is going to be slightly lower too because of interest expenses, but this one will be much lower because your interest is going to be lower than your debt, right? The interest on your debt will be lower than your debt. So this is a way of measuring, if I was your father and I put the money into the company, at the end of the year I put in $50 and I got back 15, right? Because I should get the profits. Okay? Basically I'm the owner of the company. You're just managing the company for me. Okay? And so I get the profits. So how much money did I give you? 50. How much profits did I get? 15. What return was that? 30%. Am I happy? Do you think a return on equity of 30% is good? Or not good? If you invest money, would you be happy with 30%?
Yeah.
Yes, right? It depends how risky the investment is, but generally 30% is a good return, right? How much will you get if you put your money in the bank? 15, right? So this is one way for measuring how well the financial manager is doing. So sometimes the bonus of the manager will be based on the return on equity, right? Because the stockholders own the equity. And the stockholders are very interested in the return on equity, the profit they make compared to the equity. So the stockholders, who is the boss of the financial manager? Who's their boss? Who's the boss of the company? The equity holders, right? The stockholders are the boss of the company. So they are going to decide how the manager gets his bonus, or her bonus, right? So they might say to the manager, your bonus is based on return on equity, okay? Now, one problem is that maybe that's not very fair to the bondholders, because it's an incentive for managers to take more risk. The more risk I take, and the more debt I take on, if my debt goes up to 90, and my equity is just 10, what happens now? Right? The interest will get a little bit higher. So it's 10% minus 9. It's going to be 11. It's going to be 11 over 10. Now what was my return on equity? 110% suddenly. Okay? So I invested just $10 in this company. Then it made a profit of $11. Okay? Even after paying my debt and so on. But this is more risky because the company has a lot of debt now. Okay? If I'm a manager and I just want to get a good bonus for 2 or 3 years, do I care if I leave the company in a very bad or risky situation? Maybe not, right? I already got my big bonus. My bonus was linked to return on equity. So I get a return on equity of 110%. Everybody says, you did a great job. Okay? Here's your bonus. Then next year I can leave the job. So this is one problem with just focusing on return on equity. And this was one of the problems in the financial crisis. Because some of the, especially the banks, their debt was much too high compared to their equity. Okay? So one of the solutions to the financial crisis was forcing the banks to have more equity and less debt by law, right? So they can't do this kind of thing, take on a lot of debt and just get high return on equity. So actually return on asset is a better indicator. Okay, if we look at this, the return on assets here, the net income actually is still this, or the EBIT is still the same, and the assets is still the same, so it stays the same at 20%, right? So the return on assets gives a better overall picture of the performance of the financial manager. But because it's stockholders and not bondholders who control the company, it can be that companies focus too much on return on equity. So let's look at some real financial statements. So let's use Yahoo Finance. So on Yahoo Finance, we can find the information for all of the companies listed on the US stock market, as well as other things like global indicators and so on. So if we take a company like Microsoft, so we can see here Microsoft Corporation, right? So if you want to check this yourself, you just go to Yahoo Finance, then just start typing in the name of a company here. I just wrote MI. It will come up underneath, okay? So you click on the company, and then we can see, this is Microsoft, right? The stock. This is their stock price. It's going up and down. But what we're interested in at the moment is their financial information. So we can see that under financials. On the left-hand side we have charts, news, company, analyst, ownership. So we can see who owns the company here. Financials, what do we see here? Income statement, we just talked about the income statement. Balance sheet, we just talked about the balance sheet, okay? So we click on balance sheet, we talked about that one first. So what can we see in the balance sheet? Assets, current assets, right? What kind of things can we see in Microsoft? So here we can see cash. How much cash does Microsoft have, right? All numbers in thousands. So this is not 8 million, this is 8,000 million, which is 8 billion. So Microsoft has 8 billion in cash in June the 30th, 2014, right? Then how much do they have in short-term investments? 77 billion. Is it better to have your money in cash or short-term investments? Short-term investments, you can get a higher interest rate, right? Net receivables, we talked about What does that mean? It's a current asset. They just wrote receivables instead of account. I was writing account receivables. What does this mean? $21 billion. What?
You're gonna get back cash when
They sold something and they didn't get paid for it yet. Right? They sold something but they didn't get the cash yet. So that's net receivables. Inventory, $2 billion. This is their current assets, okay? Then long-term investments. Long-term assets, right? Long-term investments, 14 billion. Property. Microsoft is a computer company. Its property is not going to be as much as other companies. So 13 billion. Goodwill, intangible assets like the trademark and so on, right? Can also be included in goodwill. So if I was to sell the name Microsoft to somebody, how much would they have to pay me?
a lot.
A lot of money, right? Maybe 20 billion, right? Do I have some patents and trademark? Yes, I have some patents and trademarks worth this much. Okay, Microsoft Office is a trademark. So, my total assets, 172 billion. Is that a lot of money?
Yes.
Yes, it is a lot of money, right? Who's the richest guy in the world? Bill Gates. How much money does Bill Gates have?
A lot.
A lot. Maybe he has more than Microsoft, I think. Right? It's hundreds of billions. Maybe. Okay, so he probably owns a lot of equity in Microsoft too. It's included, right? So what about their liabilities? Accounts payable. Okay, so on and so on. Total liabilities. Then we move down to equity, right?
Chris,
Total equity, yes?
what makes intangible assets decreases the value?
That's a good question. How do we value the intangible assets? Basically, one way of doing it is that our equity plus debt is equals to our assets. So it's really, we can say what does the market think it's worth. So if we look at our stock price and then we add up equity plus debt equals assets, then what's left over? That must be that kind of intangible asset. Okay? The stock, the market, or the people who are buying my stock are valuing my intangible asset. Okay, so good question. So we can see the debt here. Total debt, 82 billion. Right? And total stock, equity, 62 billion. So if we look over here, it's nearly 50-50, right? Not far off 50-50 equity and debt. Debt is slightly higher for Microsoft. Do you think Microsoft is a very risky company? If we look at equity and debt? No, it has a lot of equity. Okay? Maybe 45 or 40 or 45% equity. 55% debt, something like that. So if we add these two numbers together, right, then we should add up. So then we move on to the income statement. So here we can see Microsoft's income statement. So here we have gross profit, right? Cost of revenue, total revenue. Okay, so 86 billion, right? They got it coming in. Costs of revenue 26. So gross profit they call 60 million. Then underneath this we have our costs, operating expenses, right? So what kind of operating expenses? Microsoft is putting their research and development in here. Okay? Other general administrative costs. Total operating expenses. Operating income or loss. So our gross profit minus these kind of operating expenses is $27 billion. Is that good? Yes, right? So in 2014, Microsoft made $27 billion before interest and tax. So this is EBIT, also called operating income. EBIT earnings before interest and tax, this line here. Then we look at the interest expense and the tax expense, okay, and then we deduct that. Then we get our net income. Net income, 22 billion. Okay, so what was our return on equity? Can you remember what the equity was? So we can actually check this on the key statistics here. Company key statistics that tell us return on equity and return on assets, right? So here we have, this is management effectiveness. This is how well are the management doing their job, right? How well are the management performing? Return on assets, return on equity. Return on assets, 10%. Return on equity, 23%. If you were a stockholder in Microsoft, would you be happy with 23% return last year?
Yes.
So you can see, Microsoft made a big profit, right? They made a big profit, and compared to their equity, it was 20%, 23% of what their equity was, their profit. So Microsoft can either invest this profit in the company, or they can pay it out as dividends, right? Microsoft didn't pay dividends for the first number of years, but nowadays they're paying dividends a little bit. So again, we can see here revenues. Here we have EBIT, right? Net income, so on. So do you have any question about financial statements before we move on to the next part? So you should be able to look at Yahoo Finance for any company and understand their balance sheet and their income statement. You should be able to come here and understand, what's this? Return on assets, return on equity, right? Can you understand those things? Okay. Any questions? So, then let's move on to the time value of money. So, I asked you in the last class, an important question about the time value of money is, would you prefer $100 today or $100 next year? And then the next question is, why? Why would you prefer $100 today than next year? There should be 3 reasons. Okay, the most obvious reason is inflation. But what about if I was to ask you, would you prefer an apple today or an apple next year? What would you say? I can give you an apple now, or I can give you an apple next year. Inflation is not an issue, right? Is there any other reason? Which do you prefer? An apple now today or an apple from me next year?
Now.
Now, why? Hmm? You want the apple next year? Okay. Depends on the person. Those people who said they want the apple now, why do you prefer the apple now? Why do you prefer to have the apple now, today?
Because I want to eat now.
You want to eat it now. Okay, so that's an important one. That's like preference or patience. Right, we can call this patience. This is the real, it's also called the real interest rate. We call this the real interest rate for later. So some people are not patient. Okay? Some people are more patient than other people. So the value is a little bit different. But if we take the average, we can call this the real interest rate. Okay? It's basically people's preference for consuming now rather than consuming in the future. Okay? The world could end tomorrow, right? so I prefer to consume now. Or I'm just not a patient person, I want to do it now. But yes, you are a patient person, you don't mind. Maybe your real interest rate could be 0. Okay? Then the third thing, another reason why you would prefer this year than next year. Can you say louder?
Sorry.
Okay, so the last reason is risk. So there's some risk that next year I won't be here. So there's a small risk, right? Or I forget, right? Or there's a disease of apples. All the apples die. Or apples are very expensive, so I changed my mind, right? So there's some risk. So we think about inflation, risk, and people's preference is the main reasons why the money is more valuable today than in the future. Okay, so we'll discuss about that a little bit in more detail after the break time. So let's take a break now for 10 minutes. Oh, sorry, I mean out in the next class. Next on Friday. Yes.